Welcome to the webinar about employee participation, and a webinar specifically for employees, people who either already are participating or who will be participating. Because yes, you are or can become a co-owner of your company. I hope that I somewhat fulfill the requests and the questions that have come in beforehand when people signed up for this webinar. It's really meant to explain to you, okay, what happens if you co-own or if you're about to co-own a company. And in this specific webinar, what I for now focused on is employee ownership in general, certificates and options, and participation taxes. So anything that happens within taxes. My name, by the way, is Quintus Willemsen. I'm the founder of Share Council. I founded Share Council because I also have a software development company, and I want everybody to become co-owner in that company. And I figured out how needlessly difficult it is to make someone co-owner of your company. And later on, I figured out, this was in 2015. And later on, I figured out how needlessly difficult this is across the board, basically across Europe. And that's how we came to Share Council. And I'm very happy to help you guys, even if it's just a little nudge or a step further in seeing how this actually works. If you have any questions, don't hold back on preferably putting them in the chat. Or you can just unmute yourself and say it. But the easiest thing is putting it in the chat, then I can see them coming in and I'll read through them while we go through the presentation, because my experience is it's easier to go into questions when you're on topic than when you do it all the way at the end. So short little thing, very important though. The reason Share Council actually became a company is that we have a mission. We have a mission to make 100 million European employees, and that's 100 million employees is SME employees in Europe, co-owner of the company they work for, because we believe that this will close, and that's on the left side here on the slide, closing this will close the capital wealth gap in Europe by making every SME employee co-owner of the company they work for. And that was when I had this platform built for ourselves, for our own company. I later on read the book of Thomas Piketty and found out that about 63% of the capital in Europe is held by 10% of the population. And I figured that, yeah. Dina, I hear your background noise. Yeah, I understood that if it's so difficult to become co-owner of a company, yeah, and it's not weird that wealth is so oddly skewed from across the board. So that's what we're trying to do with Share Council, and that's also what shows the importance of also becoming co-owner whenever you can. At least we believe that. And it is, it maybe speaks for itself, but it really is co-owning what you're working on and co-owning the profits of what you're working on, and really as a team co-owning the results that you're driving for. And you can see this here, and these slides will be shared afterwards. But really becoming from employee to co-owner is really what it also says here: transition from an employee to a co-owner mindset. That's what also the company that offers this normally does it for. It really is a way to empower the underlying thought process of, hey, it's mine, and I'm really joining the group here in making sure we get the best results there are. There's no big lie around this for the rest. That's the main reason why you would set this up and why you would go along. And the reason I put this in this slide, I was example, Handpicked Agencies, a company in the south, and maybe there's some people from Handpicked Agencies in this call, who buys digital agencies and tries to make one group out of these companies, but while keeping the original brand names and brands and employees and groups and such. And they were looking for a way to make one big family, basically, out of all these little pods of digital agencies. And they worked on setting up a stock, which I think a lot of you in the call are either used to by using it, known to by knowing that it might come. For the ones that don't know it, a STAK is Dutch for een stichting administratiekantoor, which in English would be a trust foundation. And it's a stichting, a foundation that co-owns the company, gives out little tickets on the shares of that company, which you can buy. And they call those tickets certificates or depository receipts. And Hendrik Agencies uses that to really have everyone become co-owner of the company. And I'm really that was the first part about ownership. Okay, why do you do ownership? Why does it come there? And I think the majority of you in some way understand that part. Why do you become co-owner for yourself? Again, that's if you look at that capital spread, you want to become co-owner to assure that you gain in the profits and the results that you drive with the business. Now to the meat of it, as in more to the detail of it, and here is where more questions might arise, is so what is it? What is a depository receipt and what is an option? Those two things I'm going to explain you now with two slides that are very, very similar. A certificate, in Dutch een certificaat van aandelen, in English a depository receipt, acts as a proof of ownership. It's nothing more than a little ticket that one can buy that you own a share. It basically is the same as handing your coat in at the service at the theater and getting a number for your coat. That number means that the coat at the coat rack is yours. You don't have it at that moment. You might even argue that the one holding your coat is responsible for your coat. If that thing then is stolen, that was not your problem, that's their problem. And the ticket that you have proves that it is your coat. And let's say that you have a very special coat, and this coat pays out dividends or receives dividends, receives money in the pocket. Someone goes by the coat rack and puts a little bit of money in every pocket. Then that money is yours. It's not of the owner of the coat rack. No, the money is yours because you have that number. This is what a depository receipt is. There's a few reasons why you have depository receipts, and one of the main reasons is you do not need a notary to trade a depository receipt. So you do not need to go to a notary to sign off on a deed of transfer or anything alike to receive or to buy one of those certificates, which everybody probably in this call can imagine that makes it a lot easier to set up employee participation. Is it then really that much different from a share? Well, not that much. According to the tax authorities, according to the Belastingdienst, to the fiscals, it's the same. So financially, that certificate is the same as a share. If you want to pertain that there's a difference, for instance, sometimes at some companies, they work with a form of a discount on a depository receipts, which can be bought. Then that company upfront has requested or either has requested or will be able to request to the tax authorities, hey, by the fact that there is no voting rights on the depository receipts, we think that there is a decrease of about 10% of the price on the depository receipts. Meaning that if the share would be 100 euros, then the depository receipt would be valued on 90 euros. That is possible. There is some wiggling room there. But that's about it. For the rest, the tax authorities say, no, it's the same thing. Most people will know, if you know what a certificate is, and if you maybe even own one, most people will know that it does not have voting rights. That's not per definition always true. In the case of Share Council, if you buy one of our shares, you actually buy a depository receipt of Share Council. In our case, 100% of our shares are owned by a trust foundation, by a STAK. And all these depository receipts, or all these shares have depository receipts given out. I own, of the 1 billion, I own 10 million of them. And I have voting rights by owning those depository receipts, but that's specifically in our rules and regulations, just so you know. So that's to show how much equal a certificate is to an underlying share. And the reason I'm so onto this point is that mainly from fiscal reasons, so from tax reasons, you need to treat that certificate always as a share. and hence always as something that holds value at the moment you buy it, or at the moment you receive it, in the sense of maybe you didn't buy it, but you got it as a gift. Then make sure that you know its value that is transferred from the company to you or from another person to you. And the tax authorities has an opinion about that. So that's what certificates is. Then options. And in this case, an option on a certificate. Now for the sharp people, it is two images that are almost the same. If I switch from certificate to options, the line between stock and the employees becomes gray. That is actually saying right now the employee does not own a certificate. In the first image, the line was yellow, indicating, okay, you own a certificate, which is actually a share which came from the operating company in this case. Now you get an option on a certificate. That means you do not own the certificate yet. You only have a right to buy it at a later time for a price you agreed on today. So we agree on that in 5 years from now, you're allowed to buy a share for $100, even if the share price went up to €1,000. You're still allowed to call it and to buy it for that price. That's what you call an option. Now, I grayed out that line between stock and the employees because an option is not really ownership. What I just about the certificate said it really is. The option is really not ownership. The reason I'm specifically saying that is when you get an option, there's no value yet transferred from the company to you. That value comes to life, if you want to say, at the moment that you actually buy and receive the underlying certificate. Now there is an important part, but that's on the text parts. What happens when there's a difference between the price you pay for a certificate and the value you receive from the certificate in the form of these options being executed. It's very much tax ingrained. I hope you get an idea of what a certificate is and what an option is. And maybe you already knew. What I wanted to move into after this is more into, there's one part in between. Before I go that, I'm going to go to taxes. Last part of it is vesting. Maybe some of you already have vesting or will have vesting or will never have vesting. It's also an option. Vesting, I just wanted to quickly touch upon it. Vesting is the agreement that, yes, you just bought maybe a depository receipt or certificate, but you got to stay with the company for instance, 4 years to really make it yours, to bring it to fruition. And that's what you see here. See a four-year vesting, it's 3 years in this. No, it's 4 year with actually with a year cliff from 2021 to 2025. Now, vesting hence is a time period that you got to stay with the company to make something really yours, be it a certificate, an option, the deposit or economic ownership rights, and anything basically can be it. Now, what you often see with investing is that you have a cliff, which means if you leave within this first period, in this case, it's a cliff of 1 year. If you leave in the first year, you got to give everything back. You're not getting anything for it. We just pretend as if you never got it. And after that 1 year cliff, it builds up further and further and further. Now, in the Netherlands, we use reversed vesting if it's on depository receipts. So let's say that you are allowed to receive 100 depository receipts, and it says, okay, you have a 4-year vesting on it with a 25% per year. That would actually mean that normally you would get 25 shares after 1 year, 25 shares after the next year, 25 shares after the year after that. But what we do in the Netherlands is we give you all 100 shares in the beginning. And then we tell, okay, you got to stay for 4 years to be able to sell any of these shares and really get some profit out of it. The reason we do it, that reverse vesting, is because of tax reasons. Because the tax authorities tax you at the moment that the value is transferred between one person and the other. And if you give someone 25 shares every year, because of the vesting, it might be that every year the price went up a little bit. And then you have two things you can do. You can either charge the higher price or calculate the taxes over the higher price, or you can stay on the same price, but the person gets less and less shares every year. Well, to avoid those difficulties, you do a reversed vesting. If there's any questions about these things in the future, let me know, because vesting, of course, plays in when you eventually execute an option or buy certificates or those kind of things. Now, let's say that you get to a company exit. Let's say that the company is going to be sold, and there's one person here in the call who has 100 certificates, and there's another person here in the call who has 100 options on certificates on depository receipts. And the company is being sold. And just to make it easy, both people got them 4 years ago, and we're through the vesting already. Or 5 years ago, if the vesting was 5 years, doesn't matter. So there's no vesting on it anymore. You completed your vesting. What then happens? And there I wanted to dig into in this second bit of the presentation into the taxes. If you have depository receipts given out by a trust foundation, or you have depository receipts as economic ownership rights, that's also a possibility, then there is no foundation, basically. Just imagine, there's no foundation, a company gave out the depository receipts, and that's it. Those are the two versions of depository receipts you have. And let's say that 5 years ago, you bought these certificates for 20 euros. And let's say that after that, you work, and eventually those things, after 3 years, have a value of 100 bucks. There you have an 80 euros capital gain. Right now in the Netherlands, you do not pay over the capital gain when depository receipts are in box 3. So you have 3 tax boxes. Box 1 is your salary. Box 2 is if you're an entrepreneur and you own a company. And box 3 is all your savings. Depository receipts or shares are also seen as savings. Now let's say that you have those. Maarten, is this also going to change with the new box 3? Probably, yes, probably, Maarten, and I'll get back to you on that one at the end of this little line here. So give me a few minutes, but then I'll get back. This is a good question. For now, those 80 euros capital gains in this example are not taxed. What you did pay in the last 3 years on this was every year you paid tax over an anticipated gains. I'm trying to find the right calculation or the right translation to English. So the tax authorities in the Netherlands say if you have savings and it's more than, I believe right now it's 80,000 euros, we think that you have a certain gain on that, and we're not going to tax the gain as it is. No, we're going to do a hypothetical gain, and we think it's about 4%, and on shares it's right now 5%, I believe. Now let's say that you have 100 bucks in shares, and they say you had a gain of a hypothetical gain of 5 euros, 5%. Then we're going to tax those 5 euros with 36%, and that's the taxes you pay on a yearly basis on your wealth, and these shares fall under that. So let's say that for the rest, the capital gains are tax free. After 5 years, the company is sold, and they are sold for 150 euros. You can sell the shares. So that means you have 130 euro capital gain. And that's fantastic, because you don't, at that moment, when you receive the 150 bucks, you do not have to pay any cash over that any taxes over those 130 capital gain. That's what it currently is. The High Court in the Netherlands has ruled that this is an unfair system, which we have seen in the last 20 odd years. It was Mr. Zalm who came up with this in 2001. And now after 25 years, they said, okay, we need to change this. We need to do it basically like others do it. We need to actually tax on capital gains. That is where box 3 is going to go to, Maarten. There is though a big discussion right now. Can you and will the Netherlands charge capital gains over the paper profits, or only at the end when you actually sell it. Almost the whole financial world around us has tripled over and laughed about the Netherlands wanting to implement the taxes over the annual capital gains, which would be called paper gains, instead of over only the capital gains all the way at the end when you sell a share. And the difficulty in it is, if in this example, after year 3, you need to pay full taxes over the 80 euros capital gains, then it might be that you do not have that cash. You might have it for 80 euros, but if it's 80,000 euros and you all of a sudden have to pay 36% over that or something alike, and you only have the share, you don't have the cash, how are you going to do that? That's actually the same problem we see in options. So that's why it is an interesting question. There was a lot of pushback on this new ruling for Box 3. Right now, they're rewriting Box 3 ruling. It will probably go to capital gains, but it will probably follow the American example of raising capital gains all the way at the end of the cycle when you actually sell the share. Now, if that is the case and you are at an exit moment and you have these depository receipts, then you probably will have not paid any taxes in the last 5 years over all that cash that you have in Box 3. But at the end, you need to pay indeed taxes over the 130 euros you won on this share. Now, there's something else to it, and that's if it's an option. And that basically follows the same route. So let's say that at the moment you got the option, the value of a share was 20 bucks. But you didn't buy the share, you didn't buy the depository receipt. No, you got an option to buy it for 20 bucks in 5 years from now. So you don't pay any taxes throughout those 5 years over that option because you don't have anything yet. And I know this is a bit short on it, but it's basically what it is. You don't have anything yet until you execute an option. Now, let's say that you don't execute the option all the way to the end of the company, that the company is going to be sold. Then all of a sudden you can pay the company 20 bucks and receive a share for 150 bucks. So 130 bucks capital gains. And at the moment when the company is sold, it is often executing the options happens just a minute before the company is sold. You actually own the share a minute before the company is sold, and then you sell the share for 150 bucks. And there is your gain, 130 euros. At that moment, the tax authorities say everything you gain from that option must be seen as a Box 1 income. So you're an employee. You got this benefit from the company. You did not have any risk in the last 5 years. So we cannot say that you were an entrepreneur, nor can we say that this was savings of yours that you had stacked away somewhere, gaining some momentum. No, you literally had nothing and you executed the option at the moment the company was sold. We see that as a profit you got from the company, and we charge it all as income under income taxes. Which means that you probably pay about 49%, 49, maybe 49.5 even, 49% taxes over this amount. So the 130 euros will be deducted with 65 euros, and the rest is yours. That might seem like a really high amount. At least there's a lot of fiscalists say that's a really high amount. On the other hand, it's also, if you didn't have the option, you didn't have anything. So it's a really good deal still. Now, what you also could have done, maybe, let's say that you had a 3-year vesting. After 3 years, you executed the option. So in year 3, you actually paid the company 20 euros per share, and you received a share worth 100 euros. At that moment, after 3 years, you had an 80 euro capital gain. Now, with the new box 3 structure, you would say it's probably needs to be, oh, sorry, not with the new box 3 structure. That €80 capital gain that you see after 3 years is then also seen as income tax, meaning a salary, meaning payroll. Now, when it's €80, it's not that bad. You got to probably pay about €40 to the tax authorities to be in taxes. But again, if it's €80 with 3 zeros behind it, you got to pay €40,000 to the tax authorities, and that's gonna be a bit of a difficult one. Now, luckily, the tax authorities have seen this issue and have and the regulator has changed some ruling here. The regulator now thinks that you are not able to pay the taxes after year 3 when you execute the option. And it says, okay, you can wait with paying those taxes after the share is actually sold and you actually got cash for it. If you do that, you end up with exactly the same situation as you ended up, as I just explained. You just waited out with your option, with executing it all the way just before the company was sold. So what happens then, tax-wise, is if you execute the option after 3 years and you do not pay the taxes, that will go along till year 5, and then you'll be taxed not over €80, but over the €130 capital gains, and it will be an income tax, so the highest tax there is. If after 3 years you do actually pay the taxes, because for whatever reason you have the money somewhere, then you basically go back to owning depository receipts. So if after 3 years you execute the option, you pay €20 to the company, you receive €100 worth of depository receipts from the company, you have an €80 gain, you pay €40 to the tax authorities because they say, hey, this is income tax, you should pay for that. After that, you just own the depository receipt valued on €100. And if 2 years later the whole company is sold for €150 a share, then you gain another €50 on top of that, which is either tax-free as it is right now in box 3, or it is a capital gains tax, which is still significantly lower than an income tax on it. Now, most people will not pay the taxes after 3 years. Most people will just go along with whatever the tax authorities have set in place as a standard ruling now. Okay, we wait until you sell the options, or sorry, the depository receipts. Mind you, if you want to be able to pay the taxes, you actually have to indicate that immediately. So if after 3 years you actually want to pay the taxes, you gotta send a letter to the tax authorities or an email, say, hey, I want to pay this, and at least your company has to do that, and has to put that in the payslip. So that's one to think about if ever that situation comes. Now there is one new thing coming in. I can actually get to that later on. There's a few new rulings coming in. Before getting there, I wanted to do one more thing. What you heard me say here, what you saw me give as an example here, is that $20 that you see here on this slide of the original value of the depository receipt, and on this slide of the depository receipt, and whether that €20 was paid or not, and how that works then with options. Now, where that €20 derives from is actually important to know. I mean, on my slide, it's just me. I just wrote down $20 because it was easy to calculate with. But for your own company, you need to have a value on the depository receipt that you buy, or on the option that you execute. Because that is what the tax authorities uses to see if what you pay for the company is what you get back from the company. And if there's a difference between what you pay to the company and what you get back from the company, that difference is seen again as salary. So if you pay the company $20 and you get a depository receipt for $100, the difference is seen as salary. But how do we get to those differences? Well, that's what you do with valuation. And then here you see how important valuation is for participation. And you immediately see here Equidom. It's our partner for the valuations, and for the ones who sometimes follow the news, we are in a merger with Equidom. But I also above it set a link that you can quickly use to do really simple with 10 questions. Do evaluation and see for yourself. Hey, what is actually happening here? If you go to sharecouncil.co/valuation, you get a super simple tool to fill it out. It's to get an idea from how does it work. And you're going to see that it is an important one, especially in relation to the tax authorities. And now the last part about the tax authorities. So they they try to reduce the burden by saying, hey, you can pay the taxes later in time. That's the first thing the tax authorities did. What they are gonna push and try to push live now on the 1st of January 2027 is something new. That's another 30% discount on when you execute an option. And now going back to the example, if you have an option, any of the people in the call here having options, if you have the option to buy a depository receipt and you are in the 3-year bracket, you can pay $20 and you receive $100, and you have the $80 gain and you need to pay income taxes over that, where right now it's about $40. That could be reduced with another 30%. So that you end up on about the same that one would pay over capital gains in box 3 or when you are an entrepreneur in box 2. That's a very interesting move that the tax authority is making. They have limited right now, or they are they are going to limit somewhat the companies that can participate in this new ruling. But that is mainly the reason because it's more in test phase, for the lack of a better word, which would start on the 1st of January 2027. This is not certain yet. They're working on it right now. It's now for consultation online, and it will come in voting in September, and hopefully goes through the Parliament voting of the first chamber in December, and then be able to go live in January. And the reason we know is because we're very close in cooperation with the Ministry of Economic Affairs of setting in this new ruling, and we're helping them monitoring the ruling as well. But it's a good one to remember. If your options were given to you or bought by you or anything alike no earlier than mid-2025, all those options can then come into play for this ruling, as long as you are marked as being a startup or a scale up, and there are certain limitations to who right now can join this. We will definitely share more information about this for all those who are interested. And now I am a little bit over time. I won't make it too long in the next part, but I wanted to give you these rulings and how this works, because I noticed that for a lot of employees this is very murky water, so to speak, and is difficult to find your way through to do this. Mind you, I'm doing a master's degree on fiscal law at the moment, and the reason I'm doing it is because I find it so complicated what the tax authorities try to make out of this. So I do not blame anybody for not fully understanding or fully knowing what is happening with these taxes. And then the last part in it, eventually it's your wallet. It's what you get in. You should be able to decide as much as you can on these kind of things. What do you do when the company is sold? What do you do if you want to trigger an option, yes or no? Will you buy a depository receipt? Will you buy extra, yes or no? Can you sell it? Will you sell it? What is the vesting on that? Is important to know, and it's important to be able to stay up to date to it. At least that was that's one of the main experiences we have over the last almost 10 years of running these kind of schemes. That's about it on the information on this. And I really hope that it helps you somewhat. And I would like to say, first of all, any questions? I still have time, extra time, and space to stay in this call. For the ones that need to leave, please look at our knowledge base, sharecouncil.co/, well, if you just go to sharecouncil.co, it's CO at the end, not .com, but CO. Daniel, is there a way to stay up to date with the Dutch regulation changes? Yes, if you study, do a master of fiscal law, you indeed get updated a lot on these kind of things. Now, furthermore, very good question. We will update on our website. Our knowledge base will always update on these new regulations. And they're definitely at the website of the tax authorities. You can find this as well, although I got to give it, it's a little bit more difficult to find. You got to really dive into it. And then there is, of course, there is ChatGPT and Claude and others. Actually, Chat and Claude work very well on looking up rules and new rules and regulations. Although it's good for looking up where to find it. Do always click on the links or click on the origin of the information at Chat and at Claude, because I see that very often it mixes up referrals. It mixes up old rules with new rules and doesn't know which one goes in which direction, because it just gathers all that information randomly from the internet. So always click through to the correct data point. Then Maarten, could you elaborate a little bit more on the pros and cons between paying tax now, activating the option, yeah, versus paying the tax on the day the company gets sold? Yeah, the main reason is in this this example, if you pay the taxes on the in year 3, you own the depository receipt on year 3, which means you are an owner of the share, which means that it falls within your box 3, which means that you either, as in right now, pay the hypothetical capital gains tax over it on an annual basis, small amount, or you pay capital gains tax over it if it's after 2028 and the new ruling is in place. You pay capital gains over it at the end. The difference what you're then getting is if you buy the depository receipt in year 3 and you sell it in year 5, you bought it then for $20 and set the taxes up until $100. So basically your bottom price when the company is sold is $100. If you then receive $150 for it, there's $50 extra, 50 euros extra that you're receiving back. In the example, when you execute your options all the way at the end, that 50 euros that you're gaining extra here would also be taxed with income taxes, which would be about half of it is 25 euros would be decreased from it and paid in income taxes. If you have settled all the taxes with the tax authorities about the income in year 3, then the 50 euros capital gains will either have only been taxed, let's say it's in 2 years, so it only has been taxed for 1.6% for 2 years in a row, and for the rest, that 50 euros is yours. Or in the new ruling in 2028, it will be taxed for a capital gains tax of about 30%. That's still a lot less than according. So you literally pay less taxes if you settle the bill with the tax authorities in year 3 instead of in year 5. That's the best way I can explain that, right? Maarten, so in essence, you pay a lower percentage of tax over a smaller value of money, since the share is worth less than one on the day of the company gets sold. That's exactly what it is, Maarten. Yeah, you're paying less taxes over a smaller amount, over the small extra amount of capital gains. Yeah. That's what it is. That's also a reason why I still see a lot of people not doing this and going on until the end of the road, because they say, yeah, I find I'm too unsure of what's going to happen, and I'm risk averse. So I rather wait out until the moment that the company is sold. And yes, I know that I pay more taxes over my gains by then, but on the other hand, it's still gains, and I have low to no risk. Of course, I would always support people in saying, hey, should I pay the tax out in year 3? I would always say, if you can, yeah, do it. Because the more you own the capital, the higher the flywheel effect on it is. And next to that, owning a company could give you dividends as well if a company pays out dividends. And there's a big difference. If you have options, you do not get the dividends until the end. If you get dividends over depository receipts you bought in this option example, but did not pay the taxes over yet, then you're paying income taxes over dividends, which is very unfortunate. And if you settle the bill, you get 2 years of dividends. Yeah, that is really tax-free money. So that's a good one to know. David, I see here. So would it not make sense to always pay tax at the moment you are activating the option, since it's then the lowest value, presumably, other than possibly losing that additional money, of course. David, yeah, you're absolutely right. The only thing is, so you're absolutely right, is that it makes sense to in year 3 always pay those taxes. The sheer reason why it doesn't happen is because the money is not always there. I know that if I would now have the option to buy shares for 20 euros, and I can buy 1,000 of them, so that's 20,000 euros, and I'm paying, and I'm receiving 100,000 euros. I do not have 40,000 euros extra just flying around, flapping around somewhere to pay those taxes on it. So it's really a question of, is that capital available to settle it? Daniel, do you get taxes back if you exercise options, but then the company goes down? Good question. No, you don't get taxes back. You, co-owning a company is also co-owning the risk. It's really your company. You are, together with the others, owning the company. And yeah, if it goes bankrupt, it goes bankrupt. Then the wallet is empty. The advantage of being a minority shareholder is that do you say curators in English? I don't know, curatoren, will not come to you to settle the bill if anything is still open at the end. But no, you will not get money back. That was also the negative sentiment on the ruling that the tax authorities are trying to put on box 3. Let's say that we all agree with the fact that they, on an annual basis, tax you on the capital increase of your wealth, your capital gains of your wealth. Then you would assume that they would also give you back on the moments that your wealth decreases because there is a downturn in the market, or because a company went bankrupt or something like that. But they said, no, we're not doing that. We're only taxing on the on the way up. So it seems like a very unfair system to do. Which we as Share Council and a bunch of other companies that are very much involved in this market, we gave that back to the Ministry of Economic Affairs, saying, yeah, you really can't do this. Hence, there's another consultation right now on that ruling for box 3. It is open, by the way. It's on my LinkedIn as well, if you're interested. I have a post on my LinkedIn about the consultation that's now open about this whole box 3 setup. So Maarten, maybe one for you also to look into. You can give feedback on it to the Ministry of Economic Affairs. Now, having said that, I really hope that this gave you some extra insight on in this case, options and depository receipts. And by that, in this case, between the difference between owning value right now or owning the right to have it in the future, and how that is taxed in different ways. If you have any extra questions about this, well, look at our knowledge base at least. It could also be helpful to follow my LinkedIn profile, because I do also post quite a bit about new rulings, new regulation, or changes in the market, or those kind of things, and definitely know how to find us in this. So far, thank you all. Thanks for listening in. We did record it, as far as I know, so perhaps it could be shared.